Alright, guys, so let's talk about the frightening state of the dollar today. Now, over the past few days, we have got disturbing news straight from Jerome Powell. As we have surmised, the US economy has chosen the path of debasement. It was either you keep rates high and crush the economy, or you do the unthinkable and destroy the currency to save this house of cards. And if the Fed doesn't give in to Trump, we would have two disastrous consequences. Now, the economy could stall and the debt pile will explode even further, especially when Scott Bessent keeps borrowing money. Now, Powell has given a clear indication that interest rates will be slashed very, very soon. It could happen as soon as September, and it's time to brace for impact. So, if you're holding US bonds or dollar cash, you are out of luck. The reserve currency is probably going to tank more. Now, people really need to realize this: cutting rates is not some miracle cure to save the US economy. Even if borrowing costs crash down to 1% tomorrow, the effective US tariff rate is still around 15%. And that means companies are still spending more on their inputs. US consumers are also spending more for less goods. Now, the rate cuts are really performative during a trade war. Now, sure, there will be an impact, but whether it will turn the tables is really, really debatable. Now, Powell's statement alone confirms what our greatest fear is. Asset prices are flying up and the currency is weakening even further. Now, the S&P is up by 1.5%, while the dollar has dropped by almost 1% against global currencies. So, yes, there are winners and there are losers. And if you hold assets like stocks or gold, you will benefit. But if US debt is all that you have, your holdings, well, you just got screwed. When the Fed cuts rates, it's important to remember the mechanism why the U.S.D would drop. Now, really sit back and ask yourself one key question: what is the incentive of holding US bonds? Now, the answer is quite simple here. You want more dollars in the future because you know prices for US goods and assets are heading up. So, rate cuts really introduce a huge problem. We must understand this: the biggest gainers are consumer stocks and industrials. Lower rates means more credit and more debt circulating around the economy. Doesn't mean that the economy is fine, just that the can has been kicked down the road once again. But the foundation is even more shaky than before. Yields on a 2 year have also dropped by over 10 basis points in a matter of minutes. So now you're getting less returns to buy US bonds while prices are escalating higher and higher. So, do you see how much of a problem this is for current holders of US bonds? It also presents a crisis for prospective buyers of US debt. What is the point of reserve currency? Now, its duty is to keep its value as stable as possible. And when that doesn't happen, the world starts to lose faith. When you slash rates during a trade war, when tariffs are going higher, you make the crisis of higher prices even worse. Global investors around the world are witnessing this and they don't like what they are seeing. Now, central banks around the world have dumped over $48 billion in treasuries in a single month. They are running away from dollar assets. The underlying purchasing power is now being compromised. Now, sometimes we like to go very technical. I can talk to you about yield curves and money supply all day, but for this video, let's bring it back to the basics. Let's keep it simple. When the dollar continues to slide while Trump keeps pissing countries off, the desire to buy bonds truly evaporates. Less demand for dollars pushes its value down, a very big problem for US consumers. Now, over the last 100 years, the dollar has lost 95% of its purchasing power. Many of us know that figure probably by heart, but the recent slide is even more concerning. Since the year 2000, the dollar has lost over 40% of its purchasing power, and with this rate cut, it's probably down by 43% or more in 2025. It's not really your home, food, or stocks getting more valuable. It's simply the power of the currency dropping like a rock. And this is the dollar milkshake theory going in reverse. And here's the common line of thinking: if the US cuts rates, industries will improve. And that will result in American exports flooding the world economy. But there's a problem here. US supply chains are still stuck in a stone age, and Trump just can't afford to spend trillions of dollars to invest overseas to develop them. And because of that, the additional credit from lower rates will be moving in really predictable and really tragic ways. Will there be corporate expansions coming? Will it spur companies to hire more people? Now, maybe in some fringe industries, maybe for sectors that have an acute labor shortage, but there's a disturbing trend that signals where all this easy money is going to flow to. Now, stock buybacks in 2025 are going to top $1.1 trillion. Look at the list of companies looking to buy back their own shares: Apple, Alphabet, and a whole bunch of banks. Now, sure, if you're an investor, it would drive the stock prices up. Earnings per share will increase, but it betrays the underlying state of the economy. Massive buybacks means there's no other place good enough to invest for a decent return. Expanding operations in the US is very expensive. Everyone can attest to that. Trying to build a factory overseas also doesn't work. You won't be able to export back to the United States without punitive tariffs. So US companies themselves, they're caught in a catch-22 which they can't control. And that's why asset prices are just going up and the rate cuts are just going to worsen it. And this is going to split the US even further. Now, if you think inequality is bad, by the end of Trump's regime, it's going to get worse. But here's the big irony with the rate cuts. Even if the Federal Reserve continues to slash rates down, ultimately, it's a supply and demand game. If Besson ultimately keeps borrowing rates, keeps borrowing money, rates even on the short end of the curve could bounce right up. And this means the rate cuts could get really brutal. Now, this chart from Bank of America is a big warning. US interest payments alone have reached a record 1.2 trillion over the past year. Now, in 2025, this disaster could balloon to 1.4 trillion, 2026. And the only way to keep interest costs stable is for the 5-year bond to drop below 3.1% yield. Well, we are around 3.8% today, which means a 75 basis points cut is the bare minimum to prevent an implosion. And it will allow the debt not to spiral out of control. But when that happens, when you move ahead to cut rates by 75 points, what's going to happen? You will likely tank the fragile dollar even further. So if you're an international investor, where are you going to invest? Now, sure, some money will flow to foreign stocks. Chinese equities are strong in international bonds. They are seeing inflows, but big money, especially those in Asia, they are piling headlong into gold. The bull market probably isn't over yet, not with the rate cuts coming down the line. And listen to this. According to a 2025 HSBC survey, mainland Chinese investors are buying gold like never before. It has gone from 7% a year ago to 15% of their entire portfolio today. And that's an incredible jump like never before. And notice the performance of gold since the start of the year. And if you own bullion, you have outperformed everything, including the S&P and even Chinese stocks. Gold went from $2,600 to $3,400 today, and that's a 30% increase. It's an incredible bull run and probably isn't over yet. Now, the upcoming rate cuts are going to make things even worse. While Besson is telling everyone to buy US bonds, we must look at people's actions. What is the big money doing with their funds? Are they buying more US treasuries? Are they throwing more money into the S&P? And this is where the rubber meets the road. Because the dollar is losing value, people are looking elsewhere. They are shunning currencies. Investors are cutting away their cash levels by nearly 40% over the past 12 months. Why? Because interest rates are falling and the strength of the dollar is tanking. Meanwhile, which asset class just exploded to the moon? It's gold. Holdings increased by a massive 120%. Almost every hard asset has increased while paper assets are being shunned. Now, a few weeks ago, the US also made a stunning shift when it comes to gold. And I think we all remember when the Trump administration was threatening tariffs on bullion. Now, imagine a 39% tariff on gold coming into the United States. And that would basically cause a major ruckus that would actually tank the dollar even more. Or maybe it would be more difficult for Trump to redecorate the Oval Office.
You see the way this is looking? Look, nice. I can't tell you how much that gold costs, a lot of money. There's nothing like gold and there's nothing like solid gold, but this beautiful office needed it. It had to be representative. When we took it over, it was dirty, not clean. I immediately changed the chair and had this beautiful desk renovated.
Now, maybe this is the real reason why Trump made the clarification. And if you didn't know yet, gold imports will not be facing US tariffs. What a turnaround. Normally, you would expect the price of bullion to totally collapse, but that's not really the case. The price of gold is slowly creeping back up because nothing has changed. The dollar is still under siege from both US fiscal and monetary policy. Both Bessent and Powell, they're hand in hand, and they're going to drive the currency to the grave, which means the demand for real assets, including gold, is still going to stay strong. Now, everything now revolves around the strength of the dollar. If the Fed goes ultra aggressive in just a few weeks' time, we can expect a big shock in the gold price upwards, and because there are zero gold tariffs in the US, American buyers can now still participate. Trump backing down is actually a good sign for gold demand long term. We are now back to the traditional relationship between dollar strength and the price of gold. ING Bank says this is likely the next tailwind to reignite the rally earlier this year. As the dollar index falls in red, the price of gold increases in black. So all eyes on what the Federal Reserve is going to do in September. Central banks and countries with money are waiting to dump their bonds if the rate cuts get severe enough. And if there's one trend that's going to stay, it's going to be China's dumping of US bonds for gold. And it's something that has gone on for almost 9 months in a row and it's not going to stop. Guys, we have truly gone beyond the point of no return here. China isn't going to accumulate more US debt, and their excess money, their trade surplus, will be moved to bullion. Now, the move has been very aggressive since Trump started the trade war, but if we trace back to the Russia Ukraine war, the shift is even more obvious. Chinese holdings went from 2,000 tons of gold to over 2,200, and those are the official numbers, and it's probably much more than that. But in percentage of total reserves, it's huge. In just 3 years, we have gone from 3% to nearly 7% of total holdings. It will probably hit double digits by the end of Trump's term. There's simply no incentive for China to fund their own containment. It literally makes no sense. So dark clouds are forming in the horizon for the dollar. The Fed is about to cut rates, and the world is waiting for yet another excuse to dump their bond holdings. And for China, they're going to de-dollarize no matter what. That ship has sailed. But let me know what you think. Will the dollar continue to crash further? And what forced Trump to U-turn the gold tariffs? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.